Welcome back to the deep dive. Great to have you with us again.
Good to be here.
Looking at the market right now, it feels a bit stretched, doesn't it?
Yeah, the S&P 500 is definitely up there, historically speaking. High multiples.
Exactly. And then you've got these economic uncertainties floating around tariffs. Who knows where those are going?
And the Fed seems pretty set on keeping rates where they are for now.
Right. So it's understandable if you, as an investor, are feeling a bit hesitant, especially about, say, growth stocks.
For sure. Growth often needs a bit more certainty.
But what if, even in this environment, there are still some potentially explosive opportunities? We've been looking into some sources suggesting certain companies could, well, maybe even double investment. Say, if you put in $3,000.
Doubling your money in this climate. That's definitely intriguing.
It is. So that's our mission today. We're diving into 3 specific growth stocks that were highlighted in a recent piece from the Motley Fool. We want to really unpack their potential.
Not for the noise, interesting.
Exactly. And these companies operate in some really fascinating, cutting-edge industries. We're talking quantum computing.
Whoa, okay.
eVTOL aircraft, electric vertical takeoff and landing planes.
The flying taxi kind of thing.
Pretty much.
Yeah.
And the world of fintech disruption. 3 very different fields.
Sounds like a packed dive.
It is. Okay, let's unpack this.
All right.
So first up, D-Wave Quantum. We're jumping right into the deep end here with quantum computing.
Right. D-Wave. Their focus is on something called quantum annealing.
Yeah, quantum annealing tools. Now, what exactly? How does that work? Our source says it helps big companies optimize things like workflow, supply chains, logistics.
Basically, yeah. Think of it like this. Quantum annealing is a specific type of quantum computing good at finding the best solution out of a massive number of possibilities, like finding the lowest valley in a huge bumpy mountain range.
Okay. Finding the optimal path.
Exactly. So D-Wave helps companies find the most efficient way to do complex things. And they offer this either through their own quantum systems or via the cloud.
And the core idea, the reason it's so powerful, is the whole qubit thing, right? Not just zeros and ones like normal computers.
Precisely. Traditional bits are either 0 or 1. Qubits, though, can be 0, 1, or kind of both at the same time, thanks to quantum superposition.
Which lets them handle way more data, way faster.
Exponentially more,
Yeah.
potentially. So D-Wave acts like this superpowered efficiency expert, finding the least resource-intensive, fastest processes.
What's fascinating here is, well, you tell me, why is this specific approach, quantum annealing, so significant? Could it really disrupt, say, standard cloud analytics?
Well, I think it could, because it's tackling problems that are just incredibly hard, maybe impossible for even classical supercomputers, these complex optimization tasks. That's its sweet spot.
Okay.
So it's not just a faster version of what we have, it's potentially a whole new capability. And D-Wave, they were early. They have that first mover advantage in a market that's still, very young, but could be absolutely massive.
And that potential shows up in the growth numbers our source mentions. Analysts are projecting D-Wave's revenue to grow at get this, a 100% compound annual growth rate.
Wow. 100% CAGR.
Yeah, from around $9 million this year, 2024, to potentially $71 million by 2027.
That's explosive growth. What's driving that?
It seems to be their new system, the Advantage 2. Apparently, it's something like 25,000 times faster than their first one.
25,000 times. Okay, that's a leap.
Huge leap. And they're also trying to convert their cloud customers into buying the actual systems, which brings in more revenue per customer.
Makes sense. Log them in.
But, okay, let's address the elephant in the room. The source is clear. D-Wave is deeply unprofitable right now.
Yeah, burning cash.
And the stock looks really expensive, right? Trading at, 75 times its projected 2027 sales?
Yeah, that's steep. 75 times sales, 3 years out.
So how do investors square that? It feels incredibly speculative.
It absolutely is speculative. There's no denying that. You're betting on the potential of an entirely new market taking off.
Right.
The justification, if you buy into it, is that the market for quantum computing could become so enormous that D-Wave can eventually grow into that huge valuation. We've seen it before with disruptive tech.
Like early internet stocks, maybe?
Could be analogous, yeah. High multiples reflecting future hope, not present earnings. But the risk is massive if that market doesn't develop as expected or if competitors leapfrog them.
Yeah, it's definitely high risk, high reward.
Textbook definition. Requires patience and a strong stomach.
Now here's an interesting wrinkle from the source. The same publication, The Motley Fool, highlighted D-Wave in this article. But their main stock advisor analyst team did not include D-Wave on their separate 10 best stocks to buy now list.
Oh, interesting. So a difference of opinion within the same house?
Yeah, so what does this all mean? If you're reading this, how do you interpret that? Is it a red flag?
This raises an important question about how analysis works. It really highlights that different analysts, even at the same place, can have different criteria.
Different focuses.
Exactly. One team might be focused purely on that massive long-term disruptive potential, accepting the current losses and high valuation. That's what this article seems to be doing.
Okay.
Another team, like Stock Advisor, might prioritize, say, nearer-term profitability, stronger balance sheets, maybe a clearer path to earnings. They might have a lower risk tolerance built into their methodology.
So it doesn't necessarily mean one is right and one is wrong.
Not necessarily.
Yeah.
It means you, the reader, the investor, need to understand why they differ.
Yeah.
What are the underlying assumptions? It forces you to think critically about what kind of risk you're comfortable with.
That's a really crucial point. Understand the why. Okay, let's shift gears.
Mm-hmm.
From quantum realm up into the sky.
Okay.
Our second company, Joby Aviation. And we're talking eVTOL's electric vertical takeoff and landing aircraft.
The flying cars? Well, sort of. More like electric air taxis.
Exactly. Joby's main aircraft is the S4. It's designed to carry a pilot plus 4 passengers.
Okay, decent capacity.
Yeah, and it boasts a 150-mile range on one charge with a top speed of 200 miles per hour.
That's pretty good range and speed for electric aviation right now.
And think about the benefits. Greener than helicopters, much quieter,
Big plus for urban areas.
and easier to land in tight spots. You can imagine landing pads on buildings, skipping all the traffic below, like the Jetsons, seriously.
Huh. We're finally getting there.
And adding some weight behind them, they've got big strategic investors like Delta Airlines and Toyota.
That's significant validation. Delta and Toyota don't just throw money around lightly.
No kidding. The source even compares it to a competitor, Archer Aviation, noting Joby's S4 has better range and speed.
Like
And
that.
Joby's apparently also working on a hydrogen version.
Always innovating. So where are they with actually, flying people around?
Well, according to the source, the FAA, the Federal Aviation Administration, is on the cusp of approving commercial flights in the U.S.
On the cusp. That sounds promising. Very close.
Yeah, and Joby apparently has plans to launch its first air taxi routes pretty soon after getting that green light.
If we connect this to the bigger picture, FAA approval is the massive hurdle, right? It signals the technology is maturing, that regulators are getting comfortable. It moves the whole industry forward.
Absolutely. It's the key step to commercialization. But thinking practically, what's the next big challenge after approval? Is it just building enough planes?
Manufacturing scale is one thing, for sure. But I argue, like you hinted at before, air traffic control in busy city skies is going to be a huge, huge puzzle to solve.
Right, you can't just have these things buzzing around randomly.
Definitely not.
Yeah.
It needs a whole new system. But assuming they navigate that, the revenue potential is stark.
Yeah, the numbers are almost comical right now. Joby made only about $130,000 in revenue in 2024, practically zero.
Pocket change for a company like this.
But analysts expect that to jump to $130 million by 2027.
Whoa, okay, from thousands to millions. That assumes those commercial flights really take off, literally and figuratively.
Exactly. It's all banking on that commercial launch happening smoothly and scaling up.
But again, like D-Wave, we need the reality check. Joby is also, as the source puts it, bleeding a lot of red ink.
Deeply unprofitable.
And the stock valuation also looks steep. 93 times projected 2027 sales. Even higher than D-Wave on that metric.
So, similar story. Betting on a huge future market.
Pretty much. You're paying today for the possibility of dominating a brand new transportation market tomorrow. It's a promising long-term play if they execute flawlessly and if the market develops. Lots of ifs.
Definitely. Okay, one more company. Let's come back down to earth, maybe into our wallets.
Right.
Fintech. The company is Chime Financial.
Ah, Chime. I see their ads a lot. They're focused on making banking easier, more accessible.
Right. That's the core idea. They offer free checking and savings accounts. Big deal there.
Huh.
Overdraft protection, often fee-free.
That's huge for people living paycheck to paycheck.
Huge. And they have an early pay feature, get your direct deposit up to 2 days early.
Another game changer if money's tight.
Plus, a Visa debit card, fee-free ATM access at tons of locations, and even a low-limit credit card designed to help people build credit.
Okay, so really targeting everyday financial needs, especially for those maybe underserved by traditional banks.
Exactly. But here's the interesting part. Chime isn't actually a bank itself.
Oh, How does that work then?
They act as a kind of mobile middleman, according to the source. They provide the app, the interface, the features, but the actual accounts are held by partner banks, which are FDIC insured.
Ah, clever. So Chime handles the user experience, the tech layer.
Right. And they make money mainly from the interchange fees. The small cut Visa charges merchants every time someone swipes that Chime debit card.
So the user gets free services, and Chime takes a slice of the transaction fees happening behind the scenes.
You got it. It lets them offer those core services without charging typical bank fees.
What's fascinating here is, well, it's that focus you mentioned. They're deliberately serving lower-income users who might not meet minimum balance requirements at big banks, or who get hit with fees constantly.
It feels like a real social impact angle.
Absolutely.
Hmm.
Those features, early pay, the credit builder card, they're not just gimmicks.
Yeah.
They can genuinely help people manage their finances better and improve their creditworthiness. That dedication is arguably a key reason for their success. They found a massive market need.
And the financials look pretty solid, especially compared to the others we discussed.
Okay, how so?
Analysts expect revenue to grow at a solid 22% CAGR, from about $1.7 billion this year to $3.1 billion by 2027.
22% is strong growth, especially on a multi-billion-dollar base. Not the 100% of D-Wave, but still very robust.
But here's the kicker: profitability. Their adjusted EBITDA. That's earnings before interest, taxes, depreciation, and amortization. It's projected to turn positive next year, 2025.
Ah, crossing into profitability. That's a major milestone.
And then grow really fast, projected to hit $446 million by 2027. That's 124% CAGR on the EBITDA line.
Wow, so profitability is expected to ramp up quickly once they hit it.
Yeah. And with an enterprise value around $8.9 billion, the source suggests it actually looks potentially undervalued at just 4 times this year's sales.
Okay, now that is a very different valuation story than D-Wave or Joby. 4 times current sales versus 70 or 90 times future sales.
Big difference. Why the contrast, do you think? Chime is still a growth story, still disrupting.
I think it comes down to market maturity and predictability. Fintech, while disruptive, operates within the known universe of financial services. Banking, payments, these are established markets.
Even if Chime's model is new.
Right. The way they do it is innovative, but the underlying business handling money, facilitating payments, is understood. Their revenue streams, based on transaction volume, are arguably more predictable than betting on quantum computers becoming mainstream or flying taxis filling the skies.
So less uncertainty about the existence of the market itself.
Exactly. D-Wave and Joby are creating entirely new markets, essentially. The range of outcomes is much wider, hence the more speculative valuations reflecting that blue sky potential. Chime is scaling up within a huge existing market it's successfully disrupting.
Makes sense.
And if we connect this to the bigger picture, Chime really shows how technology can lower barriers. It's making basic financial tools accessible to people locked out of the traditional system. That's powerful. It challenges the big banks directly.
Okay, so quite a journey today on this deep dive.
Definitely covered some ground. Quantum, air taxis, fintech.
Yeah, and the main takeaway seems to be that even when the broader market looks, expensive or uncertain with tariffs and interest rates, our sources suggest there are these pockets of potentially high growth if you know where to look.
But with varying degrees of risk attached.
Absolutely. D-Wave in quantum computing, Joby in eVTOLs, incredible innovation, huge potential, but operating in very new markets, unprofitable for now, with valuations based heavily on that future promise.
High risk, high potential reward.
Then you have Chime in fintech, also innovative, growing fast, but closer to profitability and operating in a more understood market, leading to a, seemingly more grounded valuation today.
Different risk profiles for different investors.
So we've looked at the potential, the risks, the differing analytical takes.
Which I think raises an important question, maybe for you listening, to think about. Beyond just the investment angle, how might these technologies, quantum, eVTOL, accessible fintech, how might they fundamentally change how we actually live and work?
Good question. It's not just about stock prices.
Right. How do they reshape travel, problem solving, financial access, and maybe what other areas are out there, maybe overlooked, that are on the verge of similar transformations? Where's the next wave of disruption quietly building?
That's something to chew on. And connecting those dots yourself, looking at these underlying trends.
Yeah.
Well, that's where it gets really interesting. Keep digging, keep asking questions. We'll be back next time to help unpack more.
Looking forward to it.